Stan the Annuity Man here, America's annuity agent, because I'm licensed in all 50 states and I have clients in all 50 states. Hopefully you'll be one of them in the future. You looked for exclusion ratios for immediate annuities, SPIAs, single premium immediate annuities. I think that's probably what you typed in, which is exclusion ratios. So we're going to talk about that, but in essence, the short answer to an exclusion ratio is that with immediate annuities, a lifetime income stream, you're going to get a combination of return of principal plus interest based on your life expectancy at the time you take the payment. I know that's a lot, but that's in essence to answer your question short form. But I'm going to dig deeper and show you some stuff on the whiteboard and show you how exclusion ratios work visually and mathematically. So hang in there with me. Let me go grab my pen. All right, here's the trusty pen. Let me take the cap of it off. Now, if you want an immediate annuity quote, you can always go to stantheannuityman.com, and there's all kinds of stuff there. You can get books and you can get quotes and you can get everything. But if you want a no obligation immediate annuity quote, and so we can show you what the exclusion ratio is based on your specific situation, then we certainly will do that and send you those quotes that day. So this is what we're talking about, is a single premium immediate annuity, which it's called an income annuity, a pension annuity. It's the granddaddy of all annuities. It's the one that was developed in the Roman times for the Roman soldiers and their families. That's how old an immediate annuity is. So when people say, I hate annuities, really? It's just like a pension. It's like Social Security. It's a lifetime income stream. So now here's a couple things you need to know. Number one, immediate annuities are based on your life expectancy. I'll put LE. Well, let me just put expectancy at the time you take the payment. This is very simple. The older you are, the higher the payment. People say, hey, what's the best time to buy an immediate annuity? I don't know that because it's life expectancy based. Do interest rates play a role? Yes, secondary. Let's talk about that because that's what you're asking about the exclusion ratio. So it's life expectancy is the primary pricing mechanism. And number two is interest rates. Now, people have a tendency to flip those and they say it's all about interest rates, not life expectancy. It's not. With an immediate annuity, it's about life expectancy. Rates play a role, and there's no way to time it. Good story the other day. Guy calls me up and he goes, I'm not sure I want to buy an immediate annuity because I'm going to wait till rates go up. And I'm like, well, that's, let's call him Chester. Chester, that's a good idea, but if you do that, then you have to factor in the payments that you missed while you were waiting. That makes rational sense, right? What's my point? The point is, and this isn't some bad sales pitch, it is you can't time it. You can't beat the annuity company at their own game. Life insurance companies have the big buildings for a reason because they know when you're going to die. Property and casualty companies, they're always in trouble because they don't know when the hurricane or fire is going to hit, right? So let's talk about exclusion ratio. So here's life expectancy and interest rates. Those are the two pricing mechanisms pretty much on the immediate annuity side. So when you get your income stream, here's your income stream. So here's the income payment. And let's cover a couple things. Exclusion ratio applies regardless of what account you have it in. But if you have an immediate annuity in a Roth account, the income stream is tax-free because it's inside of a Roth. If it's inside of an IRA, a traditional IRA or something like that, it's called qualified. That income stream is taxable at ordinary income rates because it's inside of your IRA, right? Now, but let's talk about exclusion ratio in a non-IRA, non-qualified setting. You're getting back, here's what it's going to be. It's going to be principal plus interest. That's what you're going to see. And when you get a quote from us at stantheannuityman.com, you're going to see the total amount. So let's just say you're going to get $2,000 a month. That's the amount, non-qualified, non-IRA. Of that amount, it's principal plus interest. And I'm just going to, it depends on your life expectancy, but I'm just going to grab something out of midair. But let's just say the principal amount is $1,500 and the interest amount is $500. You're going to get the $2,000 a month for life, okay, if it's a lifetime guarantee, but you're only going to pay taxes on $500 of that. So, does that make sense? So you're getting the $2,000, $1,500 of it is return of principal, $500 of it is interest. So what they're going to do is spread out that tax liability over your life expectancy, so you're going to pay taxes on $500. So on a yearly basis, you're getting $24,000, right? And then you're only paying taxes on $6,000 of that. Does that make sense? Now, what happens when the account goes to zero? You've outlived your life expectancy. They thought you're going to die at 84 and you're now 86, and there's zero in the account. They're still on the hook to pay you, which is the value proposition of an immediate annuity or a lifetime income benefit with an annuity. They, the annuity company, is on the hook to pay you. But when it goes to zero, they're still going to pay you, but then all of that amount is taxable. Does that make sense? So the exclusion ratio applies as long as there's money in the account. Once it goes to zero, the income stream continues uninterrupted and unchanged, but at that point in time, then all of the money is taxable. That's exclusion ratio. Hopefully I didn't get too far in the weeds for you, and I encourage you to get a quote at stantheannuityman.com, and I've also written an owner's manual on immediate annuities that you might want to grab as well. Okay, I just thought of something else. We're talking about lifetime income annuities, and with all immediate annuities, they're customizable. The quotes are, you can have it life with a period certain, life with cash refund, or you could have just a period certain. So let's kind of cover a period certain. What's that, Stan? Okay, Stan, I only need 20 years of payments. Under that scenario, you're still getting back the principal plus interest. Okay, so let's do the same thing we did before. You're getting $2,000 a month. $1,500 of that is principal plus the $500 in interest. Okay, this is just an example. Obviously, we need you to get a quote at stantheannuityman.com to show specifically what it is, because rates change every 7 days like a gallon of milk. Okay, they don't live in perpetuity, right? So what happens this happens for 20 years. You're going to get this payment every month for 20 years, and you can set up monthly, quarterly, semi-annual, annual, and this ratio applies. That's your principal, that's your interest. What happens at the end of the 20 years? Money's gone. It's over. 20-year period certain means that you get 20 years of payments. That's it. Bingo, bango, bongo. All right, erasing. Let's do a different version of that. Let's just say you said, Stan, I want a lifetime income stream with a period certain. What's the exclusion ratio on that? It would be the same, but let me explain how that works. Number one, lifetime means lifetime, right? If you lived to 150, the annuity company's on the hook to pay. So why do we have the 20-year certain there? Because a lot of people want what I call a backstop, some guarantees beside it. So life means forever. So that is what it is. That's the transfer of risk. But let's just say your Learjet hits the mountain year 5. You've gotten 5 years of payments, and year 5, poof, you're gone. It was a great life. What does that mean? There's 15 more years of payments to your beneficiaries. Same example, what happens if you live 12 years? Bentley hits the tree. That means there's 8 more years of payments. But what happens if you live 21 years and die? No more money for the beneficiaries. Now, it doesn't have to be life in 20. It could be life in 10, life in 5, life in 30, customizable quotes. But exclusion ratio applies regardless of the annuitized product, whether it's an immediate annuity, deferred income annuity, which is an immediate annuity that you defer, or QLAC, which is a deferred income annuity inside of an IRA. Now, exclusion ratios apply, but inside of an IRA, as I said before, all of that income stream is taxable. So, but on our quotes that we send you at stantheannuityman.com, we'll show the total amount of income, the principal, and the interest, so you can see that breakdown, and the taxation of the income stream, which is important when you plan. Okay, we've talked about a lot today. Now, I've done another video on how non-qualified annuities are taxed, not just the ones that we talked about today, but all annuities in a non-qualified setting, non-IRA setting. Go to that video. I think you'll like that. It's more informative. I dug down on that. So with that being said, glad you joined us. Click the subscribe button because I do these videos every day. And make sure to go to stantheannuityman.com if you need quotes or you want to talk to somebody about annuities in your specific situation, or if you want to get my books. See you next time.